Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Stephen Hochberg, who is the co-editor of the financial newsletter, the Elliott Wave Financial Forecast and Short-Term Update. He is the chief market analyst for Elliott Wave International, who are based over in Georgia in the USA. Stephen, thank you very much for your time today.
Well, thanks for having me, Robert. I appreciate it.
Really looking forward to this and appreciate that this will be out in podcast format, but we are going to be looking at a lot of charts and graphs. So for those listening on podcast, we'll do our best to explain our way through it. But ultimately, I'd recommend you go and watch the video that comes with this. You'll be able to find that on YouTube and also contrariancapitalist.substack.com. Stephen, I just thought I'd start with the basics before we start looking at charts. And I appreciate different people will always know different things. So I never like to take for granted that everyone knows what Elliott Wave analysis and Elliott Wave theory is. So if we can start there with an explanation and then go into the charts, that would be fantastic.
Sure. So the Elliott Wave principle was formulated by a man named Ralph Nelson Elliott in the 1930s. He was actually laid up with an infirmity, and as he was at home studying, his mind went to what the market was doing at the time, because we just had that huge rally in the 1920s and the crash of 1929, and he was wondering what was going on. And so he started studying charts, and he noticed some patterns, some basic patterns that were recurring through all the charts he was looking at. He was using the Dow as his database, and he was looking at the same patterns that were occurring in the Dow and gold and so forth. And he said, these aren't just markets that are reacting to news events, because the news events that affect the Dow may not affect, say, gold or interest rates in the same way. But he goes, what I've discovered is there's some basic element to the natural development of human psychology that is consistent across markets. And so what he realizes is that the wave principle is just how groups of people behave when they get together and they have a lot of uncertainty as to what's going on. And he realized that people move from pessimism to optimism in a very patterned way, and they moved from extreme optimism back to pessimism in a patterned way. And he chronicled these patterns at different times, and he called it the Elliott Wave principle, obviously after himself. But it's a fascinating study in human psychology and how human psychology works, not only in markets, but in society itself. And so what we do at Elliott Wave International is we apply this model, the wave principle model, to different markets. And it's not that we can tell exactly what's going to happen in the future, but if you can tell where you are within the development of the pattern, it implies something about the future. And that's all you need to be successful, is you just need those little odds that put you above the guy sitting next to you when you're investing. And I think that's what the strength of the wave principle is.
And it's fair to say that there's a lot of different people out there have a lot of different opinions. But what I've always enjoyed about your work over at Elliott Wave is that, again, it's just looking at it's looking at these principles, looking at the charts, and going from there. So I must say I always appreciate your written commentary that comes with everything. So I'll give you a hands up for that. I think it's really, really good. That being said, looking at a chart deck at the moment, there's plenty of things to go through. So the floor's all yours. Where would you like to start? What would you like to look at first?
Well, let's first look at what an Elliott wave is. So I've got this chart here that shows a simple schematic of what an Elliott wave is, and what it comes down to is it's a patterned fractal, meaning that there's self-similar patterns at all degrees of scale. And so what you have here is a movement in the direction of the trend. You've got five waves. If we start with the circle, waves 1, 2, 3, 4, and 5. And this pattern develops always in the direction of the trend. So 5 waves up means that the trend is up. If you got 5 waves down, it means the trend is down. But when I talk about being a pattern fractal, notice that if you look at the internal dynamics of each of these waves, for example, within wave one here in circle, it itself subdivides into five waves, just like this whole entire pattern does. So there's five waves up in wave one. And then if you look down and drill down even further, say, for example, within this wave one here to start it, it too subdivides into five waves. And so this pattern is recreating at all degrees of scale, even down to 1 minute tick charts, and then all the way up to charts that cover millenniums. And so that's what's so unique about this model here. And what we try to do is figure out where we are within the development, because it implies something about the future. For example, if you can figure out that you're somewhere in here in the fifth wave of a five-wave move, it implies that you're coming into a top and you're going to get a reaction, a three-wave decline against the trend. Now, notice that this three-wave decline also subdivides into five waves, which is so unique about this model here. So the first wave down is wave A, but within wave A, you've got a five-wave decline, and within these five-wave declines, they subdivide into five waves. Three waves go against the trend, three waves up into wave B, and wave C comes down, usually bottoms somewhere around the area of the previous fourth wave, somewhere in this region right here. So this is a simple schematic. And what we want to do now is take this and apply it to the markets to try to figure out where we are. And so this chart right here, which is titled Super Cycles Waves 4 and 5. Super cycle is just a word we use to categorize a very big wave over many, many decades of time. And this right here is the market, the S&P 500, divided by the PPI. In other words, it's the inflation-adjusted S&P 500. And we've plotted it since 1928. And so we've had this correction that ended in 1948. In Elliott Wave terms, we call this a triangle. And then from the low in 1948 in inflation-adjusted terms, you notice this five-wave move to the upside. All right, waves one peaked in the 60s. Wave two came down to the early 1980s. We had a third wave up into 1999, 2000, a fourth wave, and then a final, what we think is a fifth wave up to the upside. And if you notice, each of these, this entire five-wave pattern also subdivides into five waves. For example, here from the 1948 low up to the high in 1967, 68, you have a five-wave pattern. And even within the fifth wave, you can see this 1, 2, I haven't labeled it, 1, 2, 3, 4, 5. So again, this is how we view it. It's a fractal of self-similar patterns at all degrees of scale. This happens to be a very big degree of scale. And the reason that we think this is so important in terms of our analysis is because you can count a complete five-wave rally from the low in the late 1940s. And what we learned from this previous slide is that if you can determine when you get to this point up here, well, we kind of have an idea of what's ahead, and that's this ABC decline, this three-wave decline that's going to correct this entire move to the upside. So at the biggest degree of scale, we think that there is what we call an impulse pattern, five-wave move that is complete at the recent highs. So if we now zoom in a little bit further and we look at, say, just the rally from the 2009 low, this is the Dow Jones Industrial Average in nominal terms denominated in dollars. We had an ABC correction, which was a fourth wave that bottomed in March of 2009. This decline was the Great Credit Crisis from 2007 to 2009. And our interpretation of the rally since then is that it's traced out five waves up. What's interesting here is we have this Elliott Wave channel where we connect the lows of 2 and 4, and we draw a parallel line off the top of wave 3. And oftentimes the fifth wave will end when it meets that channel line, or it bursts slightly above it in what we call a throwover. But in our estimation, there's five waves up from the 2009 low. That in the Dow, we think culminated in December of last year. And now we've rolled over and are starting that ABC decline, that three-wave ABC decline that's going to correct this entire move to the upside. So that's what an Elliott wave is. I mean, we can look at it in different indices. For example, this next chart shows the same thing, zooming in a little bit closer. Instead of looking at it from the 2009 low, we're looking at it from the 2022 low in November of 2022. And again, you see the same 5-wave pattern to the upside that we think is culminated with that push to the February 19th high in the S&P. So again, self-similar patterns. This scale is smaller than the Dow scale we just looked at, which is smaller than the S&P divided by the PPI scale that we looked at from the 1948 low. But in terms of the pattern, we see this same 5-wave move. And this next chart of the NASDAQ shows basically the same thing as we just saw in the S&P, a 5-wave rally up to the high that the NASDAQ 100 culminated on February 19th of this year, but the NASDAQ composite topped in November of last year. So these are charts, and this is what we do. We try to interpret where we are. And again, it's implying something about the future. And what this implies is that that we're going to the downside. We're going to be in a correction heading forward. Now, the wave principle model tends to work best in freely traded markets with a lot of volume, a lot of emotion involved with it, particularly a lot of emotion. You can get very clear waves. It doesn't always work in individual stocks, but sometimes it works really well. And you just have to kind of pick and choose where you see a pattern that you recognize. And this is a chart that we ran in our April issue of the Elliott Wave Financial Forecast, a stock chart of Walt Disney, which has been in the news recently. And you can see the same kind of basic 5-wave rally pattern from its all-time low in the 1970s that we think culminated a couple of years ago with a wave 5 peak. We think we've done the first wave down of an ABC. We've rallied back in wave 2. Now, I'm not sure wave 2 topped right here. We might have a slightly higher high coming in the next couple weeks or maybe a month. We're not quite certain about that, but we are pretty confident about the direction of the main trend, which is this ABC move to the downside. So we're in wave 1 of A, and here's wave 2 of A. We'll go 3, 4, and 5 waves down. That will be A, and then we'll do a B wave rally and a C wave decline, which will partially retrace this entire move to the upside. So again, this pattern that we're seeing is playing over and over in different indices and Disney, which is a major stock, which we think presents an interesting opportunity for those who might be interested in looking at the downside and things like this. I can keep going if you have any questions. Hop right in.
Yeah,
If not,
I was just sorry to interrupt you there, Stephen. I was just going to ask. Obviously, we just looked at the Dow Jones, the NASDAQ there, and the S&P. So using the forecasting tools at the moment, because I know I'd get crucified if I don't ask this question, would be that there is, judging from what we've seen, looks like we're going to go down to the downside. Are there any targets or numbers that the analysis has in mind for the US indices at all, if you have them to hand?
Targets in time are, yeah, the answer is yes, but it's highly variable and speculative at this point, because really it's going to determine the type of pattern we trace out on the downside. For example, I showed you this ABC, but sometimes these patterns, these corrections, there are different patterns to the correction. This is the main pattern. Call this a zigzag, but sometimes this B wave will come up and meet the high here in wave 5. Sometimes it'll make a higher high and then come down in 5 waves in wave C. So the downside targets and the timing are going to be dependent on exactly where and what type of pattern this traces out. It's going to take, we think, several years to play out and get to a low. And over that time, as the pattern emerges, we'll have kind of a better idea of exactly where we are and what we're going to do. But typically, like I said, you usually come down to the area somewhere in the previous fourth wave, which is the top of wave 3, if I draw a line, and the
Mhm.
bottom of wave 4. That's kind of an initial target. So here, top of wave 3 is the high that we had in 1999, 2000. And the bottom here is the low that we had in 2009. So this kind of area is an initial target of where we're looking. We could stop in here. We could get even lower than that. But as the pattern unfolds to the downside, we'll have a better idea. And that's what we write about every month in our newsletter is where we are, what does the pattern look like, what does it imply about the future?
Fantastic. Well, thanks for clarifying that. I also appreciate there's a lot of other charts that you have potentially to
Yeah,
show
we'll
us. So
go.
again, the floor's yours.
Sure, we'll just go one more to show this five-wave pattern we're talking about. We did this. This is Bitcoin on the bottom, and this is the S&P 500 on top. Now, these trends are aligned, as you can see. Not every high occurs at the same time, and not every low occurs at the same time. In fact, Bitcoin's rallying pretty strongly right now, pushing 100,000 for a coin. And the S&P is not quite catching up to that. But as you can see, it still has in Bitcoin from its start back in 2007, 8, 9, it still has that same five-wave pattern to the upside. And it tends to trend in reverse with the market. So in our view, they're really one and the same. If the market's going to go up, Bitcoin's going to go up. And if the market goes down, I think Bitcoin's going to come down. So we're seeing that kind of same psychology play out, like R. N. Elliott saw when he first formulated the wave principle. It's not only playing out in the Dow, but he saw it in gold. We're seeing it in Bitcoin. We're seeing it in stocks, and it's playing out across different markets in different ways at different points in the trend. And for example, if we zoom in a little bit closer, this is the Russell 2000 index. The Russell 2000 peaked in November of last year, and it traced out what we think is a really nice Elliott wave, a five-wave pattern to the downside. And this is wave 1 of A. Remember, the downside moves tend to unfold as ABCs. Well, this is wave 1 of that A, this five-wave decline. It bottomed on April 8th. We've been rallying since then. We think this is wave 2 or part of wave 2. Not quite sure it's complete yet. It might pop up, fill this gap here, or oftentimes, like I said, you'll come to the area of the previous fourth wave, this fourth wave high right here, around a little over 2,100. Could be pushing even a little bit higher than that, but as long as we've got this five-wave decline, we're looking for a three-wave rally. And when this rally peters out, exhausts, I think we're going to go down again. And wave 3, another five-wave rally. And the third wave should be the strongest move, should be stronger than this wave 1. Third waves within an Elliott wave are usually always the strongest wave. So you can see how this works in a bear market too. We're zooming in. For example, this is if we take a longer look and look at a different market, this is Treasury bond prices from the all-time high in the year 2020, when yields were essentially zero. So we're looking at Treasury bond prices from the peak. And again, we're seeing the same patterns that we saw on the way up, we're seeing on the way down now. We think we're tracing out a five-wave decline in bond prices. We're in wave 5 of this five-wave decline. We've got a nice Elliott wave channel where we connect the ends of waves 2 and 4 with the endpoints of wave 3 that kind of guides where prices are going. We've tested this channel in this wave 2 rally here within wave 5. And I think bond prices are going down to the downside, which means interest rates are going to the upside. So again, we don't know for certain what's coming in the future, but based on the development of the pattern, we have kind of an inkling of where the trend is and the direction. And as this keeps unfolding, we'll have targets that we'll be talking about as we move forward in the market. So again, it's the same patterns across all freely traded markets. Here it is in the U.S. dollar. from the low in 2008, which was a low that we caught in real time. We've traced out, again, an Elliott Wave, a 5-wave rally that carried up to a high in 2022. That was the end of the 5th wave, and we're now in this ABC decline. We did wave A down, wave B up, and wave C down to retrace this Elliott Wave. We showed this in February, and we actually updated it for our newsletter this month, the May issue of the Elliott Wave Financial Forecast. And we've added some sentiment indicators here. We use sentiment to help us kind of orient where we are within the wave structure. It helps determine, are we near the end of the 5th wave, or we have more to go? Because usually you'll get extremes in 5th waves. And one of the extremes that we saw coming into the low in 2008, and remember, the dollar had been declining for 6 prior years. Every single year it was down, coming to 2008 low. And then we saw an article that said that supermodel Gisele Bundchen wanted to be paid in anything but US dollars. Now, we said, if a supermodel is so cognizant of the direction of the US dollar, that's a sentiment extreme. We must be getting near a low. And so we actually bottomed in March of 2008, traced out that 5th wave up to the upside. And by the time that 5th wave peaked in 2022, we were seeing tremendous amounts of articles with titles like "All Hail King Dollar," because people were so excited because we'd been rallying since 2008. So that was kind of a signal that we were near the end of the 5th wave. Of course, we had this channel. The 5th wave met the top of the channel and burst above it very briefly. That's called a throwover in Elliott Wave analysis. It completed the pattern, and now we're in this ABC decline. As we were approaching the top of wave B, we had been rallying for several months over here, retracing a large percentage of wave A, and the Economist came out with a cover showing a rolled up $100 bill blasting into the outer space with the title "Envy of the World." Again, that was a pretty big sentiment signal to us that we're near the end of this B wave, because people are getting very bullish. And in fact, we peaked in January of this year. Dollars declined 11%. We came down. We retraced a Fibonacci 0.382 of this entire advance at this low. Fibonacci is the mathematical basis to the wave principle. I can get in that a little bit more later on, but we have retraced this mathematical retracement, which is we look for targets. We're in the area of the previous 4th wave, haven't quite got down to here, the bottom of wave 4. So we're not exactly positive the wave C is over, but we think this substantial portion of it is. And at the low, we had the same economists come out with a cover of the Scream, the famous painting, with a title saying how a dollar crisis would unfold. Well, this title is actually 4 months too late, because it should have been up here to have any value. But the fact that it comes as we were down 11% suggests to us we're coming into a low in the US dollar and are looking at a big rally. So as soon as we have confirmation that low is in place, we'll be talking about this with our subscribers. So that's the basic concept. I mean, we talked about bonds. We talked about the US dollar. Dollar is coming into a low. Bonds are going down. We talked about a high in the U.S. stock market, and this is how we apply the wave principle and what we do at Elliott Wave International.
Thank you for going through that chart index. There's a lot to look at. So again, people listen to the podcast, I recommend you go and look at the videos, and you can see all these charts for themselves. Just so I've got this clear in my head, I appreciate looking at the treasuries and the major indices, the Russell index, so forth, that's quite clear that's on the downward trajectory. With the US dollar moving forwards, obviously looking at this chart here, there'll be a bit of a bounce. But are you saying that the general trend for the US dollar is in an upward trend, or it's in a downward trend at the moment? Just for confirmation.
Right now it's in a downtrend in this C wave, but we think the downtrend is mature and we're coming into a low. We're not quite sure the low is in place just quite yet. It might be, but we need a little bit more evidence. but we think that even if it's not, we think the majority of the decline that we've had from the 2022 high is behind us. So we're coming into a low for the dollar, which is not a popular opinion, which
Mhm.
gives us confidence that we're pretty much on the right track. That's a little ironic there, but we think we're coming into a low, and that implies a pretty significant dollar rally moving forward. And as soon as we're able to confirm the low, we'll be communicating that to our readers.
That almost sounds like it's a contrarian thought process there, Stephen, which is lovely. This is what we love to do here. I appreciate time's a bit tight. You mentioned Fibonacci there, and of course, there's a lot of charts. So, given the time that we have left, is there anything you haven't discussed or shown us that you think people need to see before we wrap up?
One chart that's really interesting to me is this chart. It just shows the S&P 500 in terms of gold, which is real money. And when you look at the history of the market in terms of real money, you can see the peak value occurred way back here in July 1999. And since that time, we've traced out an Elliott wave to the downside, a 5-wave decline, and then we've had a 3-wave rally back that peaked in 2011, and now we're heading back to the downside. And so, to me, this is an interesting chart because it just shows that what we've had in nominal terms, in terms of the dollar, is just monetary inflation. In reality, your purchasing price has been declining because of monetary inflation. This index is down, or this S&P gold ratio is down 72% from its high. So if the market was denominated in terms of real money, there'd be no question we're in a bear market right now. And we think in nominal terms, the market is going to start rolling over and start reflecting what we're seeing in real terms, which is a bear market across the board.
Well, I think on that note, I think that's a fantastic place to finish. I would like to thank you for your time. I've certainly learned a lot from the charts as well. So thank you for that. I would just like to
Yeah. One,
also
one, let me
point,
just
go on.
let me just interrupt one quick note for all the people watching this. We put together a very special offer that you can find at www.elliottwave.com. Elliott Wave is one word. There's 2 L's and 2 T's in elliottwave.com/contrarian. And if you go to that, elliottwave.com/contrarian, we have a special offer for people watching this podcast right now or listening. And it involves my newsletter, Elliott Wave Financial Forecast, Bob Prechter's newsletter, The Theorist, and a 3 times a week short-term update that I write every Monday, Wednesday, and Friday. We have a special low price for people who are interested. We think it's a great way to just kind of learn Elliott Wave and find out, what we do and why we do it, and see if it might interest you.
I really appreciate that. Thank you very much. I will make sure that that link is in the YouTube description if people are watching this on YouTube, and also the post that comes with this on Substack. So again, if you go down to the bottom of the post, you'll be able to take advantage of that special offer that Stephen and the team have put together for listeners. I really appreciate that, Stephen. Thank you very much. Uh, Again, I've learned a lot from there. So again, go and take advantage of that special offer. I hopefully look forward to catching up again, maybe in 2026, and we'll see what the lay of the land is then, if that's okay with you.
No, I'd like it. Thanks, Rob. Yeah, definitely.